24 hours with JB. Let's talk. PCE. The Fed prefers this inflationary measure more than CPI because it covers a broader range of spending. PCE, anytime you hear that, know that that's the Fed's preferred inflation gauge, right? That's personal consumption expenditure, PCE. Anytime you hear CPI, consumer price index. All of this deals with inflation. You often hear people speak about inflation, but they don't speak about the metrics in which measures inflation. That's considered the CPI as well as the PCE. Remember those terms, beloved. Let's keep it going. For a developed economy, so let me just stop right there. Developed. You have developed versus developing. In economics, you hear those two terms, developed, developing. The U.S. is a developed country because we're well established. We're basically here. A country like, who's struggling right now? I know Argentina's going through something. Basically a company of a lower standard, a lower caliber, right? That's considered a developing country, right? That doesn't mean they're starving, eating out of a garbage can per se, but they're anywhere from eating out of a garbage can to rising above that, right? Anywhere in between, but they're definitely not up. But that's tricky because I want to say, and now I have to go to my notes, that China is a developing country, which to me is sort of political. But nonetheless, we're going to keep it going. With that being said, for a developed economy, a good range for GDP growth, GDP, gross domestic product. Basically, it's the report card of a country. How well is that country doing overall? That GDP will tell you, gross domestic product. So, for a developed economy, a good range for GDP growth is generally considered to be between 2% and 3% annually, with anything above that signifying a strong expanding economy, historical average being around 2.5%. Let's keep it going. Again, we just giving out free game. We giving out free games. We giving out free games. So, in years when the value of your fund, this is talking about mutual funds, right? Mutual funds is basically a plethora of stocks, right? And you have fund managers who charge you an expense ratio, fee for managing that. And with mutual funds, they typically follow certain sectors, whether that be industrials, communication services, etc. They basically do the investing for you, and they pay you, you pay them for doing that service, right? Some people like it, some people don't. It's a lot of politics. I would have to do a whole video explaining the mutual funds in its entirety. But usually you have mutual funds versus ETF. Mutual fund is basically what I just told you. ETF, exchange traded fund. That tracks the market as well. But the difference is ETFs, you could trade them during trading hours when the market is open, right? You could trade in and out of them like a stock. However, it's not a stock per se. It follows a certain amount of stocks. So I'll give you an example. Let's say, for example, there was a food ETF, right? A fast food ETF. That ETF would consist of McDonald's, Wendy's, Burger King, and White Castle. The reason why people invest into ETFs is because of this. If I invest into McDonald's, if I invest $100 into McDonald's and the stock goes down tomorrow, I could potentially lose a significant amount, right? So thus, I diversify, right? I spread I lower my risk of my stock dropping expeditiously by investing into all four of the fast food restaurants in which I just named, McDonald's, White Castle, Burger King, etc., right? I get exposure to that whole market instead of just investing into one, because that could be considered risky. Let's keep it going. In years when the value of your fund declines, you may still be on the hook. I remember this. A fund manager can realize gains on individual securities when the overall basket on securities lose value. That means you, the investor, may be paying taxes on realized gains for a mutual fund that is worth less than it was when you bought it and that you haven't sold. Worse yet, if you invest in a mutual fund late in the year, you're on the hook for any tax incurred over the entire calendar year, even though you weren't invested at that time. In other words, a mutual fund, they invest in different quarters, right? And they sell stocks. Like I said, they handle your account themselves, right? We're talking about mutual funds again. So thus, let's say if you decide to invest into my mutual fund Monday, right? Now you invested $100 into my mutual fund Monday. If I sell everything that's in my mutual fund on Tuesday, I am going to get taxed by IRS. Me as the mutual fund controller, let's say, I'm going to get taxed by the IRS. Now, that's fair to those. I'm going to get taxed by the IRS for selling the stocks within that mutual fund, right? IRS has to get paid. Anytime you sell a stock, there's a tax incurred. There's certain stipulations, but for the most part, there's a tax incurred on those capital gains, right? That's what we refer to as the profits on the stock. Walk with me. So, thus, like I said, if you invest into the mutual fund on Monday and I sell the mutual fund on Tuesday, it's not fair to you because you are getting taxed on what took place before you, right? Previously. Why that's not fair is you weren't in the stock. But now that you're in it Tuesday and I decide to sell it this day, now you're getting essentially penalized, right? Taxed for coming into the mutual fund on the day that I sold it or the day prior. I know it may sound like a lot and I could do another video, but again, I just wanted to slide through the notes on this one. Let's keep it going. What else we got? Since 1927, the median annual return for the S&P 500 is 14.7. That's not bad. It's also 14.7 during election years. The market is higher 83% during an election year and is usually lower or up less the year after. The market is higher 83% during an election year and is usually lower or up less the year after. Let's keep it going. Give you a good one. The net profit margin. Net profit margin considers all expenses, taxes, and interest to show how well a company can pay its debts and taxes. It's calculated by subtracting interest and taxes from operating profit. That's the net profit margin. That's very good to know, and that deals with accounting. What else we got? So, under Chapter 11 bankruptcy, there is slightly more hope that the company can survive and your stock will not become worthless. Chapter 11. Chapter 11 allows a company to reorganize so that it might become more profitable once again. Under Chapter 11, again, we're dealing with bankruptcy, right? Management runs the day-to-day business operations, but significant decisions are made by a bankruptcy court. That's Chapter 11. Let's go. Quantitative easing. You'll hear this term a lot. When you do hear it, they refer to it as QE. Quantitative easing is when central banks pump money into the economy to encourage spending. Think of it as turning on the water tap to flood the system with cash to keep things flowing. I'm going to give you a prime example. COVID. When that happened, the stimulus checks, that's quantitative easing, right? You want to stimulate the economy. What is quantitative tightening? Quantitative tightening is simply the opposite of that. Heavy on investments.